Well, hi everyone, and welcome to the Buffett and Beyond Weekly ETF Letter. And do we have a surprise for you? And remember, this is Saturday, August 19th, 2023. We're going over the healthcare ETF, and as an added bonus, the long and short strategy. In other words, how can you lose less during those bear markets like last year? This is going to be very exciting, and we're going to keep doing this week after week on the various strategies or the various ETFs that we use. So let's get going right now. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And the XLV is the healthcare ETF, folks. Now, this is year to date, and this is the black line is the S&P 500, and which is up about 13% as we speak. And you can see the XLV has done nothing over the past, well, not the past 1 year, but year to date. But let's look further. Over 1 year, black line S&P 500, we can see that the XLV, the healthcare ETF, has returned about the same as the S&P 500. And you can see that during certain down periods, like right in here over to the left-hand side of this chart, you can see how the healthcare keeps a better posture and is more defensive than some of the things that go on relative to the market itself. Now, over 5 years, we can see that it has almost kept up with the S&P 500. S&P 500, again, black line, and they're both up almost the same, with the S&P 500 beating them a little bit. Now, what's not shown here are the dividends, and the healthcare companies pay out higher dividends. So when you include the dividends, they are probably returning about the same. So that means to us that this is a good ETF that we could go in and maybe pick the better stocks in that ETF to outperform the ETF. That's what this is all about, folks. So let's go in and we will look at our top 5 stocks, and this is year to date. So it's the end of 2022 right up until the other day, intraday, and we can see the healthcare is down 1.7% year to date, as we showed in one of the charts. S&P 500 up 13.8%. Our top stocks up 12.9%. But I want to show you something here. If the long-short strategy is you want to short stocks that don't do as good or do worse than your better stocks. So the long-short strategy, or the ETF strategy, our ETF strategy, is to pick the best stocks with the highest clean surplus return on equity in any ETF. And just about every ETF that we have studied going back, and what the ETFs that we've been doing or using over the past 3 years, we have outperformed that ETF with our top stocks. So right now, with the XLV down 1.7%, we want to short the ETF but go long the top stocks, and that's exactly what we did. Had we done that at the beginning of this year, we would have been up 14.7%, because you're long the better stocks and you're short the rest of the or the entire ETF. So that would give us 14.7% return right now, which is really pretty good. But it gets even better than this, folks. So let's take a look at the IYT, which is a transportation ETF, and I'm going to show you more of the long and short strategy. So again, over 5 years, the transportation has underperformed the market, but it pretty much travels with the market. In fact, it actually leads the market a good part of the time. And you can see that what the market does, the transports are going to do, or I should say, what the transports do, the market's going to do. So let us look at the transport ETF and our top 5 stocks for 3 years. So this is year to date right now. We want to go short the ETF, and we want to go long, in this case, our top 5 stocks. So the ETF is up 21%, and our top 5 stocks are up 47%, but don't forget, we're doing long short. So we short this, which means if it's up 21%, we lose that 21% because we're short this. But we're long the 47% return of the top 5 stocks. So we would be returning 25% or almost 26% right now year to date. Let's go back to last year, which was a horrible, horrible year, 2022. The transportation ETF was down 22%, 22.8%. Don't forget, the S&P was down 19.5%. The QQQs, the NASDAQ 100, down 33%. So it was a tough year. So our top 5 stocks, if you were in the top 5 stocks, lost 26%. However, we were short this ETF. So when you see a negative there and you're short, that means you made 22%, but you lost 26% on your stocks. So overall for the year, if you in the long and short position, you were down 3.2%. Again, S&P down almost 20%, the transportation's down almost 23%, and the QQQs or the NASDAQ were down 33%, and you would have lost 3.2%. This year, the IYT, the transportation index, is up 25%. So if we shorted that, we'd lose that. Top 5 stocks, folks, this is amazing, 83%. So we lost 25%. We made 83%. Together, we gained 57.7%. Now, what did we learn from all this? We learned that in a good year, we don't make as much as we would if we were just long the top stocks. We made, instead of making the possible 47% so far this year, we made 25, call it 26%. But last year, when the market was down and our top stocks were down, we were down only 3.2%, folks. And while everybody else was crying and screaming, and remember the NASDAQ and the QQQs down around 33%, this strategy lost you just 3.2%. In 2021, when we had a good year in the transports, we gained 57.7%. We could have made 83%, but because we were in a more or less long-short hedged position, we came up with 57%. So let's see here. If we were up, if we just did long those stocks, our top stocks, we would have been up 47%, down 26%. So we're looking at a positive 21%, and then add 83% would have been up about 100%. We're just adding these, it's not compounded, so over 100%. But if we hedged, if we went long and short, we would be up, let's call it 26 here, down 3 here, so up about 23, plus 57, we're looking at about 80%. So had we been just long the top 5 stocks with the transport ETF, we could have been up 100%. Simple, adding up the 3 returns. But because we didn't want to go through a year like this where we could have lost our shirt, we could have been very unhappy for all of the year actually, we were up 80%. So that's the give and take on a long short portfolio. You don't make as much as you would in a good market, but you certainly don't lose nearly as much in a down market, and let's say most of the time. And let us look at the technology ETF for 2022. I would have more numbers here, but this takes a long time to put together, folks. So in 2022, the XLK, the technology ETF, was down 28%, and our top stocks were down 26%. So that's pretty even right there. However, because we were short the XLK, we actually made 28%. We lost 26% on our long stocks, and we came out ahead. This is last year, 2022, when the market was down. S&P down 19.5%, the QQQs and NASDAQ down 33%. We actually would have made 1.9%. Nothing to crow about, but I'll tell you what, it's better than losing 26 or 28% or 33%. So that's what a long/short strategy can do for you, and it works really well in the ETFs. And folks, next week we're going to have even more ETFs, and we'll show you the 3 years. Good year in 2021, bad year in 2022, and a good year so far this year. So, folks, we've had a tough week in the market. We've had a tough couple of weeks in the market, and it's the weekend. Go out, clear your heads, go to the beach, go for a walk, sit and watch TV, be with your loved ones, whatever you want to do. Stay safe, and folks, we'll see you back here next week.